let's take a look at the different types of accounts. Retirement accounts, regular accounts, annuities. Why? Because you got to put your money somewhere, right? And we discussed these in detail in the Business 121 Financial Planning and Money Management class. So let's quickly go through them. And of course, if you have any additional questions, you can go to that class and take a look at the more detailed explanations, or just contact me. Slide number 2. This graph that I created, this graphic, I'm not very good at it, folks. I apologize. They're supposed to look like buckets or bins or bolsas, something to hold something in. And there are two major types of accounts. There are taxable accounts, which also are sometimes called regular accounts. And then there are what the IRS calls tax-qualified accounts. The biggest one being retirement accounts, but there are also health savings accounts, medical savings accounts, educational savings accounts, and they're similar, so let's just concentrate on the retirement accounts. Now, there are some subtle differences. The taxable accounts have no limits on contributions, where the retirement accounts do. And you'll hear people, when I ask them, what would you do with $100,000? They'd say, put it in a Roth IRA. No, you can't. It'll take you a long time to do it because you only can put $5,500 per year if you're under 50, and then $6,500 per year once you turn 50. So the IRS, the Congress actually, doesn't want you taking $1 million and putting it into a retirement account. It's for the working class grunts, you and me, to put in a little bit of our paycheck every month. Whereas if you have $1 million, you put it in a taxable account, no problem. The Congress has also said, look, whatever you can put into a regular account is whatever you want. You can put stocks, bonds, mutual funds, cash, but also options contracts, futures contracts. You can do buying on margin. You can short stocks. You can put anything in there, right? Any kind of type of investment. Whereas, look, this is your retirement, folks. Stocks are risky enough, right? Some mutual funds are risky enough. So we're not going to allow you to do certain transactions such as shorting or margining actually there's some exceptions. There are ways to put the covered call we discussed in chapter 15 on stock options. Yeah, there's a few things. You actually can put real estate into an IRA. Don't do it. It's very dangerous. And then here's the big deal that we are more interested in. With a regular account, you pay taxes every year. With a tax-qualified account, you either defer your taxes until later, or the newer way is the Roth IRA, the Roth post-tax contributions that eventually, assuming you hang on long enough, your earnings will be tax-free. And although there are many subtle and not so subtle differences, the major differences are how they are taxed by the IRS, how much money you can contribute, and what you can have in the account. And so we're just, as I said, briefly going through these. If you have more questions and more specific questions, please contact me. Or look it up and do a little bit of research on your own. You'll find that sometimes it's confusing, but most of the time it's pretty straightforward. Slide number 3. As we said, there are two major types of tax-qualified accounts, retirement accounts, pre-tax and post-tax. The pre-tax are the older ones, and they said to you, look, you put money away in a traditional IRA, used to just be called the IRA, put money away in a 401k and a SEP and a Simple and a KEO. We're going to give you a tax break now. We'll let you reduce your taxes now while you're working and you need the money for your family or whatever. And then in retirement, we'll charge you the taxes when you pull it out. But in 1998, a gentleman by the name of William Roth was the senator from Delaware, and he was pushing this idea of, look, some people don't need the tax break now. Let them get the tax break later. And so that's why it's called the Roth IRA. It's named after William Roth. we now have Roth 401ks, Roth 403bs, but they're not legally called that. That's why we put parentheses around them, because the IRS, the Congress, doesn't call them that. They just are 401ks and 403bs that allow you to put in post-tax dollars. And we'll discuss those in more detail later. But the idea here is, look, you're not going to get a tax break now, but some people don't need it. You get a tax break later. Tax-free in retirement. Very, very cool. Okay, so let's look at each one in detail now, okay? Here's the IRA, the Individual Retirement Arrangement. Huh? I thought it stood for Individual Retirement Account. Well, everybody in the world calls it the Individual Retirement Account, except for the IRS, because that's its real name, the Individual Retirement Arrangement. It's the most popular personal retirement plan, and now they refer to it as the traditional IRA to reduce any confusion with the Roth IRA. And anybody with earned income can contribute to a traditional IRA. There's some confusion about that with the Roth because the Roth has some limitations on contributions. But anybody, doesn't matter how much money you make $1 million, you can put it in an IRA. Now, there are limitations on whether or not it is tax deductible if you have a retirement plan at work and you make over a certain amount of money. So if you have a 401k, 403b at work, or other employer-sponsored retirement plan, then if you make over a certain amount, depending on whether you're married or single, then your contributions may be tax your contribution. You can still make the contributions, but they may not be tax deductible. So they'll be post-tax contributions, and this is where it can get confusing because then you have to keep track of how much was post-tax, after tax, and how much is pre-tax, before tax. Because when you go to take it out, you don't want the IRS saying, hey, it's all taxable if you've already paid taxes on it. So they call it the basis. I don't know why, but that's what they call it. How much money is post-tax. And you have to keep track of that. And it gets a little confusing. The contribution limits increase with inflation, and the investment grows tax-deferred. You pay taxes on the money as you withdraw it once you retire, normally after 59.5 years of age, and you must start taking the money out at 70.5. You don't have a choice. And this is one of the things that William Roth, who the Roth IRA is named after, was very adamant about. He was in his 70s in the Senate and having to take money out of his IRA, and he was still working. So the Roth IRA does not have that mandatory age limit. Slide number 5, the IRA that has all these cousins, the 401k, the 403b, 457, 401a, the SEP IRA, the Simple IRA, the Solo 401k, the SAR SEP, which has actually been discontinued. You have to have one grandfathered in, but you can't start a new one. The KEO, which is not as popular as it used to be, and then the Roth IRA. They all work very much like the traditional IRA, where you put money in now, you get a tax break now, and then later on in retirement you take the money out and then you're taxed. Except for the Roth, which, as we said, does not give you a tax break now, but gives you a tax break later, and the Roth 401k, the Roth 403b, which is, they're not really called that, but they're simply a 401k, a 403b, with the ability to put in post-tax dollars, dollars that you've already been taxed on. Slide number 6. So let's take a look at an example. You put in $100 into your paycheck. You put into your 401k $100 through your paycheck, via your paycheck, and what happens? Well, the feds and the state of California give you a subsidy. They give you a tax break now. It depends on your marginal tax rate, and we discuss that in detail in Business 121, Financial Planning and Money Management, so take it if you haven't done so already. So let's say you're in a 25% tax bracket. That means that your take-home pay will not be reduced by that additional $25. You put in $100, and your take-home pay is only reduced by $25 from the feds, and now the tax breaks for the state of California don't match. So let's just say 8%. It might be 7, it might be 9, you don't know. So let's just say 8%. So you're getting a subsidy of $33. And your take-home pay is only reduced by $67. You put in $100 into the account, and you see only $67 taken out of your paycheck. Very cool. Plus, your company may have some kind of match. You put in $100, they put in $50. You put in $100, they put in $100. Think about that. 100% return in your investment in one day. Who's going to give you that? Only your employer. Why? Because they don't want you around later on when you retire. They don't want to have a traditional pension plan. They want you to go away. So they're willing to give you some money now to make you go away later on. Okay, so what a deal. You put in $100, you only see your take-home pay reduced by $67. What's the catch? There's always a catch, right? Yes, you're right. There is a catch. Slide number 7. You're going to pay the income tax on the dollars withdrawn in retirement. But that's okay. People in retirement are usually in a lower tax bracket. And if you're not in a lower tax bracket in your retirement, congratulations. Why? Because that means you're taking out a ton of money out of your retirement accounts. I hope all my students and all my clients and myself, we all have that same horrible problem in our golden years of having too much money in our retirement accounts. And of course, what happens if you withdraw the money before retirement? They slap your hand, make you pay the income tax, and make you pay a 10% penalty. In other words, they're saying, look, this is for your retirement. Leave it alone. Let it grow. But there are some exceptions: first-time home purchase, higher education, medical disability, financial hardship. There are some exceptions. But basically, you're going to kiss this money, send it on its way, and then come back to you 30, 40 years in the future, depending on where you are. If you're younger, of course, longer. So it has a longer opportunity to grow. Does that sound cool? I think it is. I think it's very cool. Slide number 8. What about the Roth IRA, the Roth 401k, the Roth 403b? Well, if you contribute to a Roth IRA $100, what do the feds give you? Nothing. What does the California give you? Nothing. Total government subsidy? Nothing. Your disposable income is reduced by $100. So why would you contribute to a Roth IRA? Now here's the answer, because you're going to do it, because everyone should have a Roth IRA. We're not allowed to say that, but I say it anyway. Let's say you contribute to a Roth IRA, and your friends and your family say, "Why are you contributing to the Roth IRA?" Here's your answer. Why are you contributing to a Roth IRA? Slide number 9. Because a Roth IRA is so cool. Yeah, dear students, tax-free in retirement is a golden opportunity. No other investment choice, apples to apples, if you compare like situations, comes close, in my humble opinion. Eventually, I think they're probably going to stop them. I don't know, maybe I'm wrong, but they're going to see billions of dollars in the feds, I'm talking about, and the politicians and the state, in these Roth IRAs, and they can't tax it. Now, some people say don't trust them because later on they're going to make you pay taxes on it even though they said they weren't. I don't know that's going to happen. You can't know what's going to happen 20 years in the future, but still, it's a great deal. And another cool thing about the Roth IRA is you can withdraw the contributions at any time with no penalty. Why? Because you already paid taxes on the contributions. That makes sense. You see, you paid taxes on the contributions when it went in, and so those contributions are yours. You can pull them out, no taxes, no penalties. Not the earnings. If you pull out the earnings, you have to pay taxes and a 10% penalty. But the contributions are yours. And this makes the Roth IRA also an excellent intermediate term investment account. Buying a home, other high-ticket item, I think they're great for college expenses. Why? Because they're currently not used in the financial aid calculations. And what people will say is, well, should I start an educational savings account for my child? And I say, well, have you contributed the maximum to your Roth IRA yet? And they say, no. I say, do that first. Do that first, because when you go to fill out that FAFSA form, not the FAFSA, what people call it the FAFSA, but it's the FAFSA form, they don't ask how much is in your Roth IRA. And it doesn't reduce your financial aid calculations. Whereas if you put money in a 529 educational savings plan, you're right, exactly. So those 529 plans, they tend to be from higher income individuals. Is that cool? Oh yeah. Roth IRAs are so cool. Well, an Roth IRA is not for everyone. Well, yes it is. You just have to learn how to navigate the paperwork. See if you can follow me on this one here. There are limitations on Roth IRA contributions, depending on how much money you make. Only single taxpayers with an adjusted gross income of $122,000 or less in 2019, and the amounts go up with inflation, and married couples with an adjusted gross income of $193,000 or less in 2019 can fully contribute to a Roth IRA. If you don't qualify, congratulations. I don't feel too badly for you. However, you can still contribute to the Roth IRA anyway. Well, many people don't know how much money they're going to make, especially if they're in business or sales or whatever. So you go ahead and contribute to the Roth IRA anyway. And if you find that you've made over the limit, or you already knew you were going to make over the limit, you can recharacterize the contributions into a traditional IRA. That's the verb that the IRS uses, recharacterize them. Because the traditional IRA doesn't have the same earnings limitation. You do it before you file your taxes. Actually, you can do it after, but do it before you file your taxes. And then, on the very same day, you turn in the paperwork at the exact same time, you convert the traditional IRA back into the Roth IRA. Who voted for these both? Oh, yeah, we did. That's the tax law, dear students. What can we say? But this is what the IRS says you can do. Recharacterize the Roth IRA into the traditional, then turn around and convert it immediately back into the Roth. Yes. Can everybody agree that the tax law is broken? Yes. Can everybody agree on how to fix it? No. Oh well. Slide number 11. The contribution limits go up with inflation. So currently in 2019, you can put in $6,000. That's a lot of money, $500 a month for many people, into a Roth IRA. But remember, it's post-tax, so on the way out, many years from now. And you have until April 15th of the next year, obviously tax day, to put the maximum. Now you can't put $6,000 in Roth and then $6,000 in traditional IRA. No, it's $6,000 no matter how many IRAs you have open. And if your spouse is not working, you can contribute on their behalf. So as long as you made, say, $12,000, you could put $6,000 for you and $6,000 for them, that person. And then if you're 50 or over, you add to, you can add to that, another $1,000. And as we're going to see on this slide, slide number 12, you see the amounts increasing with inflation. These are the 401k, 403b contribution limits. In 2017, 18,000, 2018, 18,500, 2019, 19,000. So see, they're going up with inflation, and they're very, very generous. I mean, think about it, folks. You put $19,000 away for 5 years in your late 20s, early 30s. You'll never have to touch your retirement account again, assuming you invest for long-term growth prudently, consistently. Don't panic. Don't get too greedy, and the world doesn't end. Yeah. So think about it. You're married, 2 incomes. You can live off of one income, stuff the other income into a 401k or 403b. And note that if you're 50 or over, $25,000. That's a lot of money. And there's a loophole in the law that I didn't believe at first, but it's true. If you work for a school district or another nonprofit entity and they have a 403b and a 457 you can put the entire amount into both. So that's 19,000 times 2, 25,000 times 2 if you're 50 or over. Wow, that's pretty amazing. And I'm surprised they didn't get rid of it. That started back in 2002, 2003, and now it's in the tax code. Slide number 13. This is very cool, dear students. A tax credit. Say you're not making a whole lot of money, but you're putting $50 a month away into a Roth IRA. The feds might give you $300 back at the end of the year, up to 50% of your contributions with a maximum of $2,000. And for 2019, the limits are very generous, in my humble opinion. $32,000 or less for a single filer, $64,000 or less for a married filing jointly, and then in between for head of household. If you do your own taxes, do not forget this. If you have someone else do them, make sure to remind them that you put money away into a retirement account. And tax programs like TurboTax, Tax Act, and TaxSlayer handle these very well. So they'll pick it up just like that if you tell them, oh yeah, I put money into a Roth IRA or a traditional IRA or a 401k. They'll grab it. If you don't claim it, is the IRS going to call you up and say, hey, we got some money? No, that's not going to happen. So you have to do it. But it's still cool, don't you think? I do. So take that tax credit for putting $50 a month away into a Roth IRA in your 20s or 30s. Cool? Yeah. Slide 14. The Roth 401k, the Roth 403b. Now, we put quotes around these because that's not what the IRS, that's not what the tax code calls them. They just call them 401ks, 403bs with the ability to put in after-tax dollars. So again, like the Roth, you don't get a tax break now, but later on you get a tax break in retirement, which is a golden opportunity in my humble opinion. And if you don't need the tax break now, this is a very good choice. But there are some problems here. Remember the contributions that we could take out of the Roth IRA? That doesn't fly here. Plus, any employer matches will continue to be pre-tax, so you've got to keep track of how much was post-tax and how much was pre-tax, because when you go to take the money out, you don't want the IRS to say it's all pre-tax and tax you twice. And so, as we say at the bottom, this is a great option for those that do not need the tax break now. However, I prefer the Roth IRA just because of the counting issues, but that's not an important issue, right? If your employer offers a matching contributions, this is a no-brainer. You do it. And what I've done, and it's, again, everybody's different, is my wife and I have used the Roth IRA, and I've put money in my 403b tax, pre-tax. So we've used the post-tax contributions for the Roth, the pre-tax for the 403b, and so that's worked for us. So we have some pre-tax, some post-tax. We got some tax break now. We'll get some tax break later. You decide. You decide. You decide. Slide number 15. Now, what is an annuity? Annuities sort of straddle both worlds. They have some strange characteristics that the life insurance companies have been able to extract out of the Congress. It's a life insurance product, and they were designed originally to provide a guaranteed income. Annuity options include income for a set number of years, such as 10 or 20 or 30 years, for as long as you live, that's the life income option, or for as long as you and your spouse or any other dependent lives, if he or she outlives you. And this is often something that is very, very tempting to individuals. The ability to not outlive the income that the annuity creates. The amount you get is based upon your age, which of the above options you pick, how much you've contributed, how well your annuity investments have performed. There are two major types, fixed annuities and variable annuities. Fixed annuities generally invest in bonds and pay about 2 or 3% less than what bonds are paying, depending on what's going on in the bond world. Variable annuities allow you as the investor to choose which mutual funds you want, stock and bond funds, balance funds. And again, usually pay about 2 to 3 or more % less than what mutual funds pay. Where's the extra money going? Take a guess. What are some of the advantages and disadvantages of tax-deferred annuities? Well, you can fund them with retirement account dollars or after-tax dollars. And there's no limit on contributions. So you have $200,000, boom, you can put it in a tax-deferred annuity. You'll make that annuity salesperson very, very happy and even send them on a Caribbean cruise. And also, if you have retirement account dollars that you want to put into an annuity, you can, and they will continue to be tax-deferred. The interest that you earned is tax-deferred, and you pay taxes on any pre-tax annuity contributions and all tax-deferred earnings as you withdraw them in retirement. And as with other retirement plans, when you retire, you will likely be in a lower income tax bracket. The downside is that these things have really high fees, folks. The annuity company usually takes between 1.5% to 3% every year on top of the mutual fund fees, if it's in a variable annuity. And so when people are asking me, well, they said that I wouldn't outlive my income, I say, yeah, you're right. You know, they're right. They're going to pay you a certain amount for the rest of your life. But here's what they're actually saying. Is they're saying, look, instead of you creating the annuity, you being the investor, you have a nest egg, and we've already seen what happens if we put it in bonds or stocks and bonds if you go back to Chapter 11. Will give us the money, because once you give them the money, it's theirs. And if you live 2 months, oh well, they get to keep it. If you live 40 years, oh well, they still have to keep paying you. And we will invest for you. Don't gamble with your money, because if you make imprudent decisions, you could wind up with, mediocre results. Instead, give us the money. We guarantee you will have mediocre results for the rest of your lives. Look, I'm an insurance agent, dear students. Insurance companies are not stupid. They're very, very smart. They're very profitable. I could sell these things. I refuse to do so. And you would, if you go on the website under Chapter 11 in BUS123, I think I put them all here on the 123 class also. You'll see some of the perks that we the salespeople get if we can sell these things. They'll send you on a Caribbean cruise for 7 days. It's in my humble opinion, it's outrageous what they do. But hey, that's why there are choices out there, and you, dear students, have to educate yourself and watch out for and I get into heated arguments with other insurance agents and other brokers about these things, because they've convinced themselves that they're doing you the best favor in the world while they're getting their Caribbean 7-day all expense paid cruise. Slide number 17. So to review, what types of accounts are there? There are the regular taxable accounts where there's no limit on how much you can put in. There's no limit on your type of investments. You pay taxes every year. And then there are the retirement tax qualified accounts, either pre-tax or post-tax. Tax break now, tax break later. And then the annuities that have high fees, and you get to defer any earnings until retirement. Cool. And again, I went through this quickly. I apologize if I skimmed through it too fast for you. But you might want to bounce over to 121, Financial Planning and Money Management, Chapter 14, where we do this in more detail. We also discuss it a little bit in Chapter 11 in the introduction to investments. And the fundamentals of investments. And of course, you know who to contact if you have questions. If you just type into any search engine retirement accounts, you'll get 70 million hits. And so there's plenty of good information out and a whole lot more bad information. Be awesome, dear students, and think long-term, you younger folks, because you have the ability to create a very, very comfortable retirement for yourselves. If you have a long-term perspective, invest prudently for long-term compounded growth, and the world doesn't end. See ya!